Hi, folks. Adam Taggart, co-founder of Peak Prosperity, here back for another week of making sense with the markets. Today, we're joined by a special guest, John Rubino, proprietor of dollarcollapse.com and frequent contributor to peakprosperity.com. And as always, too, we're joined by the lead partners of New Harbor Financial, the financial advisory firm endorsed by Peak Prosperity. John Rubino, thanks so much for joining us this week. It's great to see you.
Hey, Adam. Hi, everybody. Good to be here.
And you're joining us from the Pacific Northwest, right?
I am, where summer is finally here.
I'll bet that's welcome after many months of being under forced lockdown.
Mm-hmm.
And John Lodra and Mike Preston, great to see you guys.
Hello, guys. Good to be with you.
Adam, good to see you again.
All right, so John Rubino, thank you so much for joining us today. I know you have a very busy schedule, and I'm really appreciative of the fact that you've taken some time out of it to join us here. My question to you is, given that context that I've just laid up, and the point here about the Fed and its actions, I know you just recently wrote a post where you quoted Doug Noland, who claimed that Q1 2020 was, quote, the single most outrageous 3 months in financial history. And he did say, well, that's until we see what the Q2 numbers for 2020 are going to be. But he was talking about these trillions of stimulus that the Fed and the other central banks have shoved into the markets, into the system, distorting asset prices even further, creating greater wealth inequality. At the same time, we're hearing really big name investors like Mohammed Al-Arian and Jeremy Grantham saying that they're extremely uncomfortable with what's going on. And these are more establishment type guys. I think Grantham just said this week that this is the biggest asset price bubble he's seen in his entire investing career. He's seen a lot of bubbles. So my question for you here is, I think we're really at a binary point. Either the Fed has won and basically markets are not going to go down from here and they've rescued the system, and anybody who has wealth hasn't lost it yet through this process should just throw it in the markets and let the Fed take care of them. Either that's the case or it's not, and we're setting ourselves up for the mother of all disappointments here. What's your take on the situation?
Well, my take is that we're still in the pattern that's been in place since at least the 1980s, where the government borrows a lot of money and convinces the private sector to borrow a lot of money, creates a financial boom, which turns into a bubble, which bursts and requires an even bigger amount of stimulus from the federal government and from the central bank to recover. And in each iteration, the booms have been bigger and the busts have been bigger. So this is the biggest of all time, as you said. We've never seen anything like this, but we're within the pattern still. So now the question becomes: is there any kind of monetary and fiscal policy that pulls us out of something like this, where we're back at Depression era levels of unemployment? At the same time that we've got more debt than any society in the history of the human race has ever accumulated. So at some point, it becomes impossible to fix things. And as you said, that's the question now. Have we hit that point, or can we do it again? Can we inflate another bubble going forward that's big enough to pull us out of this? And since I thought 2005 was basically the end of this game, and I was 100% sure that the Great Recession, 2008, 2009, was the end of it, where we had taken on too much debt to be salvageable, and the system had to collapse and had to reset and had to be recreated in some more sustainable way. So I'm not a very good source of timing information on all this, but it does seem like we're reaching the point where that brick wall that we've got to hit is out there in the not too distant future, just because these numbers are insane. We borrowed just immense amounts of money. And what we're seeing in the shorter cycles of the stock market right now reflect that. As soon as the liquidity starts to moderate, stocks tank. And then the central bank and the federal government have to step in with some kind of liquidity, either lower interest rates or asset purchases or massive fiscal deficits, with which to rev the stock market up again. It's not about the real economy anymore. It's about financial asset prices. So that's the indicator that they're looking at, and that's the the public policy lever, which they now focus on getting right. So when, as you mentioned, monetary liquidity is moderating right now. It's not outrageously easy when you combine government borrowing with Fed asset purchases, which means that the stock market is due for another crash here in the not too distant future, which will force the Fed and the government to ramp up fiscal and monetary stimulus. We're going to see $1 trillion infrastructure program, apparently, pretty soon from the federal government. And even though the Fed is saying interest rates are not going to go negative, they kind of have to in the next year or two. So a couple of years from now, we're liable to be having a very similar conversation, except the numbers will be even crazier, where now the government's deficit is 10% of GDP, and the 10-year Treasury is negative 0.5%, and then we'll be saying, wow, can we go further? If the system doesn't blow up between now and then, because they can play these games as long as the currencies they're using to manipulate the markets are still considered to be valuable by the markets themselves. So as long as the dollar is in demand around the world and is a quote unquote strong currency, we can do stuff like this, and we can do it basically forever until that changes, until people lose faith in the currency. So that's the big thing that we need to watch out there, not levels of stock prices or housing starts or government spending or any of that stuff, because they can manipulate these markets and keep them rising or at least stable for as long as they want to, as long as they have a currency with which to do it. So that's really the key. When the dollar starts to fall, or when some other major currency blows up, then it's game over. But until then, they can get away with a lot of crazy stuff. And one last thing about the Fed buying asset prices. In previous cycles, usually there's dumb money that comes in, but it's corporate share buybacks or retail investors coming in and buying with their little accounts. And that gives the markets that last spasm, before they crash. But now we've got a new kind of dumb money in the markets, which is central banks, and they have unlimited amounts of currency creation ability, and they're completely indiscriminate. They aren't looking at PE ratios or anything. They don't care about the Buffett indicator, I don't think. They're just going to buy the S&P 500 across the board when the time comes, and that's the wild card, because they don't care about valuation and they have unlimited amounts of money. So it's not clear where the end is for the stock bubble in that kind of a circumstance. I mean, we'll know it when it happens, because it will begin with the dollar falling in value really dramatically against real stuff, which is to say a rising inflation. But until that time, there's no real valuation measure that you can look at and say, well, okay, their stocks are overpriced now and they've got to collapse, because the Fed doesn't care about stuff like that. So I think that's the main thing that differentiates this time from previous times, and that we have to pay attention to, because it's new and it's big, and it's potentially a game changer in the short run.
Okay. Got so many questions that has sparked for me, John. You've talked on a number of things that we've talked about in past episodes here. Relatively recently, we talked about the dangers of shorting the market. A prudent person could look at these levels of overvaluation and say, this is probably a really good time to short, because we're at these extreme ends of these historic charts. But to your point, the Fed doesn't care about valuations at this point, and they have an unlimited checkbook. I'm curious if you have an opinion about shorting the market. Is it too dangerous right now, at least for sort of the novice or intermediate investor to consider, because the Fed can kind of rescue any dip? Or does it make sense under certain circumstances, knowing this is not personal financial advice for any viewer here?
Yeah, well, at the peak of every cycle, a handful of shorts who time it just right make fortunes. Okay, that's where life-changing money comes from for a lot of people. But you've got to time it right. Like if you saw the movie The Big Short, those guys got the story right, but they were all early, and so they all suffered badly for a while until their big bet worked out, and then they did just fine, spectacularly fine, in fact. So anybody who's seen that movie or who has any kind of a sense of stock market history knows that history says this is a phenomenal time to be shorting this market. You know, you should mortgage your house, short all of the FANG stocks, you know, all the big tech stocks that are leading this market, because that's happened before in history, and every single time the handful of stocks that were driving the final stage of the stock bubble collapsed, and you could make a fortune by shorting them. So it's really tempting if you just use history as an indicator. But again, the Fed being in the market and being, you know, ready, willing, and able to buy equities when and if it becomes necessary means that this is a somewhat different time. So I got some stock market shorts right now. You know, the S&P 500 is really the easiest thing to short. So I buy long dated put options on the S&P 500. And so far, the last batch of shorts have not worked out too well. But I can't resist doing it to an extent, just because. And this isn't investment advice, folks out there. Don't do this at home, because it's dangerous. And I've been at it for a long time, and I'm only playing with money I can afford to lose. But it's hard to resist, just because, yeah, this is the most overvalued stock market in history, which means it has the furthest to fall to get back to historical norms, which means a leveraged short bet could be a 10-bagger very, very easily if history repeats. But again, you know, the Fed may not let history repeat. So there's nothing you can say with any kind of certainty, because we're in uncharted territory. But I will say that it's damn tempting to see these valuations and know how far they can drop just to get back to a normal valuation.
All right. Well, thanks. So I'm sort of this, you know, thinking that what we may enter into with the markets, at least, is a period not unlike the coronavirus, where what we're sort of engaged in right now is what's called the hammer and the dance, which is you bring the hammer down, you bring your economy under lockdown, and then you begin to loosen it back up until cases begin spiking too much, and then you have to tighten again. Right, and it becomes this process, and the hope is that the wavelengths become a little bit lower every time. Right, the peaks of new infections become lower every time that you begin to release again. But it's this long process of, you know, tighten, release, tighten, release. You know, we may be in a position where the markets, which so desperately want to correct if left to natural market forces, you know, things start breaking, Fed responds with huge amount of liquidity, and we're just sort of trapped in this space where the market never really gets the clearing event it needs, but we're getting increasing volatility as the Fed keeps trying to goose it higher, but each new burst of liquidity doesn't goose the market quite as much as it did before, right? And so you're sort of trapped in this up and down range. Curious if you have any thoughts on that, but the question that I wanted to ask you was, what do you think is more likely here? That you mentioned the Fed can do this basically until people lose faith in the currency of the dollar, right? The dollar is the world's reserve currency, and most other major fiat currencies out there are doing what the dollar's doing. Their central banks are printing as well, and it's not like on a relative basis, they're a heck of a lot better than the dollar. In fact, the world still looks as the dollar is the safest play there. Do you see this ending at some point in a collapse of the dollar because of what the Fed is doing? Or do you think, and I consider that a monetary breakage, or do you think it fails because the wealth inequality that is being created and accelerated by the Fed and the intercentral bank's actions get us to a point where so many people have lost so much of their future prospects that they rise up, and it's more of a social breaking versus a monetary one first? Do you have an opinion on that?
Well, yeah, those things go together. When you know, when we're losing faith in a currency, what we're really doing is losing faith in the government that manages the currency, right? As long as we trust those guys to be competent and honest, then we can trust the currency that they're running. But as soon as we decide that they're in it for themselves and their rich patrons, and the system is basically working for the 1% and not the 99%. And, you know, you get sort of what happened over the last few weeks where people just hit the streets. You know, there was a approximate cause for that, which was yet another police brutality video. But what fueled it, what gave it legs, was the fact that everybody's so frustrated. You know, there was a rising inequality even before the pandemic hit. And then the people who were least able to afford it were the ones who got the least help. And so you've got millions of people who've been stuck on basically house arrest for 2 months while their kids didn't have enough to eat and they were losing their jobs and nobody was available to help them, while the richest guys in the country got richer. The 1% made money in this most recent stock market recovery. They are actually richer than they were when the pandemic began on average. And that's the kind of thing that leads to civil unrest, which leads to potentially a currency crisis. If people lose faith in the system from whatever point of view that they're coming from, whether it's police brutality or economic inequality or other social justice issues or whatever, it can lead them to lose faith in the government, and that in turn can cause them to lose faith in the currency. So that it can happen that way. But one thing you don't want to do is compare the dollar to other currencies, because that's not the main metric. All the major fiat currencies are going down in value, just at differing rates. What you want to compare these currencies to is real stuff. How much does it take to buy the necessities of life and to buy safe haven assets? If you want to protect yourself by buying gold, silver, farmland, maybe oil wells, things like that, and the price of those things are soaring, which is what happens in the early stages of currency crises, because smart capital flows into that stuff first before everybody else does, then if you're somebody who's watching that happen and seeing those things run away from you so that you can't protect yourself financially anymore, then that's liable to cause you to panic. And that panic stage is what the Austrian School of Economics calls a crack-up boom. When people just flat out don't want to hold the currency anymore and they start buying real stuff whenever they get paid. And that pushes the price of real stuff up even more. And so you get kind of a runaway inflation, but what it really is a runaway decline in the faith we have in the currency. So that's what I see out there somewhere. And as long as these major fiat currencies continue to be seen as valuable by the rest of the world, then, it won't happen. But, we're seeing the price of gold go up now, which is an early warning sign for stuff like this. And we're seeing huge stock market volatility, which is kind of a warning sign, because it's a sign of distress as much as it is a sign of optimism. Even though we're in the upward part of the cycle now, the downward part of the cycle will come soon. And then you've got the political turmoil that comes from civil unrest and financial instability, and that leads to elections that tend to skew populist. And we're also seeing that around the world, where people from outside the mainstream are being elected, and they're doing things that are unpredictable, because populism isn't really a political philosophy where it has a set number of things it intends to do once somebody gets into office on that philosophy. So we have uncertainty in the political realm, uncertainty in the financial realm, and extreme disgust on the part of the people who are left behind by whatever good things are happening. And that's when people lose faith in the currency. So I would say that the last couple of years show that we're not far from that. We're seeing trouble in pretty much every sector. And once people put the pieces together that, it isn't just this one sector where there's trouble, just not politics or just not finance, but they see it as across the board dysfunction in today's big systems, then that's when you get this kind of phase change in market psychology. And, I think we're not far from that based on the crazy world that we're looking at when we look out the window. So, this could happen much sooner than it seems like it's going to right now. So again, timing is impossible to predict, but it could be that 2021 is the year when everything falls apart.
Okay. And I'm not going to put you on record saying that 2021 is the year it's all going to fall apart, but if it did, no, you mentioned gold earlier as something that you should measure the dollar and the world's other fiat currencies against to see how they are falling or rising, but right now they're really falling compared to real stuff, price of real stuff. I know you follow gold closely, and I know you follow the gold mining stocks closely, and that's something that the guys at New Harvard do as well. I want to let you go soon because I know that we promised we wouldn't take up too much of your time today, but do you have any parting thoughts to share about the outlook, at least for gold right now? It seems like given everything that you've just listed here, gold probably does seem like a pretty sensible place to park some capital this time.
Yeah, gold goes up in this kind of a situation because people get nervous and they look around, and gold is the thing that has held its value for 3,000 years, which you can't really say about much of anything else in this world, so money flows into gold, and then that pulls silver up. But the mining stocks are what's, I think, really unique and interesting right now, because they're almost alone in having the prospect of really, really positive comparisons over the next couple of years, where the price of the thing they're selling is going up, but their costs are not rising because oil is down somewhat, and one of the biggest costs of precious metals mining is fuel for the big earth-moving machines that they need. So their margins are really blowing out right now, which means they're going to report good numbers. And I think investors are going to look around, and they're not going to see very many good numbers coming out of very many other industries, which is going to give the gold mining industry this unique kind of earnings momentum, which ought to translate into price momentum, which ought to pull in a lot of what they call generalist money. In other words, people who aren't necessarily gold bugs and aren't all that knowledgeable about that sector, but they see it moving. And they want to be part of what's moving because they assume there's a reason for it. And generalist money dwarfs the current amount of money that is in the precious metal sector. So once that starts flowing in, you get these big gaps up in the value of a lot of related assets. And I think that there's a good chance the next few years are going to see a lot of that, where first the Newmonts of the world start rising, the big well-known gold miners, and then the people who make money in those things start looking around for who's next, and they work their way down the food chain until they get to the exploration companies, which become like lottery tickets. So I think that there are going to be a lot of 10-baggers in the precious metals sector, and it becomes a question of, how do you ride it? Do you start with the big ones and work your way down, or do you jump right into these little potential 10-baggers? And then how do you choose those 10-baggers? Those are tough questions, and you need expert advice. That's another don't do this at home kind of thing, because there are landmines in this industry, but there are also gold coins waiting on the ground just to be picked up. And I think that's the investment play of the next few years.
All right. Well, thanks. And that's an excellent segue. Gives me an excellent segue into what I want to ask the guys from New Harbor. But I do want to thank you for your time, John. So we're going to let you go. But thanks so much. We hope to have you back on the program again soon.
Great. Thanks, guys. Bye.
Take care, John.
See ya.
Hi, John.
All right, New Harbor guys. I don't think we could have had a better tee up for you guys, because given all the risks that John talked about, that's why your portfolio is so defensive. And you have, I believe, still more or less sort of net zero long stock market exposure, with the exception of the precious metals mining space. So I guess first off, let's start with you, John, then we'll move to you, Mike. Do you have any reaction in general to the arc of what John laid out, and then specific to the miners, if one or both of you can give kind of your current update on what your portfolio is invested in, how you guys are looking at the space, anything that viewers would want to know in terms of what your guys' strategy is based upon the factors that John mentioned there. So John Lodra, why don't we start with you?
Yeah, sure. No, I think I think John nailed the big picture there. I think it's clear if you look at data, and I think he pretty much acknowledged that, just on a data-based look at the world, we are in a massive, massive bubble. The kind of pullback in stock market prices that would be needed to kind of get back to quote unquote normal valuations is just massive, right? So every great bubble has a story, a seductive mantra that investors of all stripes tell themselves, and are aided and abetted by those that are propagating the story that the Fed has our back, and they'll keep. The theoretical argument is, yeah, they can keep doing it until the currency collapses. We certainly understand that construct. We're a little bit, I think, more critical or pessimistic of that story actually being able to play out in such an easy, kind of layup kind of scenario that investors essentially come to believe is possible. And I think, John, I think rightly pointed to, and I think Adam, you teed this up, are we talking about a monetary breakage or a societal breakage? I don't think we can underestimate the societal breakage. Look, part of what we do is try to educate our clients as to the leap of faith they're having to take by being in markets. And it is a big leap of faith to just basically put one's retirement security at risk to say, oh, don't worry, the Fed's got this under control. Don't forget, we're talking about an entity that has been in their heads and wrong about almost everything they've tried to do, including, being truthful, if not ignorant about certain matters. So we certainly are going to be less sanguine about that story. Look at what's going on right now. The Fed is basically entering the corporate bond market in a big way. First buying corporate bond ETFs, and now more recently they've talked about going directly to corporate bond issuance. If you look at a chart of where corporate bond yields have been over the last several decades, we are literally at all-time lows. The yield on investment grade corporate bonds, I think, reached 2.2% or something like that in that neighborhood within the last day or two. And there was a little spike up in there in March when the COVID thing was taking its full flight. And if you look at that in the context of the long-term chart, it was like, are you kidding me? Yeah, this was the dysfunction in the market that essentially caused the Fed to, what they're doing is breaking the law. They're violating the Federal Reserve Act. They're not entitled or able legally to go buy securities and put the public at risk for those securities without collateral that's not defective. So they don't have that collateral. They're buying secondary bonds in a secondary market of companies that they're not saving these companies from going bankrupt. They're bailing out investors. These are dollars that are being robbed from the CARES Act that could and should be being put into the circular flow into households and real areas of the economy that they can actually do their intended work for Main Street. So I think we're not so far away from the societal breakage of this nice narrative. And we're not inclined in our roles as fiduciaries to be sanguine as the market is in general about, don't worry, the Fed can control this. We actually think that's a huge leap of faith that we are not willing to encourage our clients to make. We'll talk about it and at least talk through ways they can try to take that leap with some protections, but it's not quite the layup I think that the Fed and the markets want you to believe.
All right, and Mike, let's hear from you here. Anything to add to what John said on sort of the macro picture, and if you can give some detail as to the gold exposure of the current portfolio and how you guys are looking at gold right now in this environment. Fire away on that.
Sure. I think that both John Rubino and John Loder did a great job of talking about the macro picture. So I don't really have much more to add to that, other than our single most important or single most common question we get is, can't the Fed just keep doing this forever? I don't think they can. I think politically it's becoming more difficult. As John Rubino said, they can do it as long as there's confidence in the currency, and we can lose confidence in the currency in a lot of different ways. And as John Loder just said, we're probably not far from the breakage point where literally the Fed is pushed too far and the inequality becomes so great that folks start to wake up and get mad about it. So I guess that's all I'd say about that. We like gold and silver mining shares, precious metal mining shares. They remain a key component in our portfolio. We have anywhere between 10 and 15% exposure. We like them a lot. As John Rubino said, their comps are going to look great as gold and silver continue to either stay here or increase in value. They offer a leveraged bet on gold and silver because their prices stay pretty fixed, but they get all of the expansion and the increased prices. So we maintain a position. We do have it hedged. We have a fairly tight hedge on it because of the fact that downdrafts like we saw in March can really knock these things down pretty quickly. And so we have put options below our position in miners, maybe about 10 to 15% below current prices. We offset the cost of those put options, which is essentially an insurance policy on that stock, by selling partial call options, basically meaning that using GDX as an example, if it's trading at around 33, we might be willing to sell some up at 40. And by selling call options up there, we take that money and buy put options down at, let's say, 28, 29, or 30, which will allow us to put a floor in the price. But we frankly think that the mining shares are going to go a lot higher. John Rubino was just talking about some 10 baggers. We have exposure to the whole sector versus some micro caps. So 10 baggers would be great, but we frankly would not be surprised to see GDX, for instance, which is at 32 or 33, be in the 40s by the end of this year, going into next year. So that's a core piece of our portfolio. And yes, we are still net flat, the U.S. stock market, other than that. And we just continue to watch this bounce, this second wave bounce, if you will. It continues to grind along sideways, kind of maddening everyone that's watching it. Today's volume was one of the lowest in a long time. So we think we're close to an inflection point, but we're patient and we're waiting for it.
All right, good summary. And I just want to underscore something that John Rubino said, which is while mining stocks do offer tremendous opportunities when you have, especially like a crack up type boom in the sector, that sector has been an extremely volatile sector over the past decade and has honestly largely been kind of a widowmaker sector for the period between the beginning of QE to date. And so I just want to underscore his point that if you're going to be investing in mining stocks, you should really do that under the supervision of a professional, whether it's a firm like New Harbor or whether it's a professional that analyzes these mines, publishes a newsletter, goes out and visits the mines and stuff like that. And there are some of those people out there. But I would say for the vast majority of people watching, mining stocks are something that you should only put your money in once you've gotten a more foundational defensive position in that's safe. And then if you're going to get into them, most people should probably play just with like the indices like you guys have talked about, like GDX, which are the big mining companies and a diversified portfolio of them. As you get into the juniors, which is the smaller companies, or like the small exploration companies that John Rubino was talking about, yes, if you time them right, they can give you amazing returns, but you can lose your money real fast. So working with a professional to pick the right instruments for your risk profile is important. And Mike Preston mentioned something I think is really important to continue to understand about New Harbor as a company is they use hedges to make sure that if they're taking on risk, that they are putting an insurance program in place so that if that risk goes against them, meaning if the stocks don't do what they expect them to do, they have limited their downside. And when you're dealing with really risky things like precious metals mining companies, that is a very smart strategy to pursue. So guys, we're approaching the end of our time here. It's always great to be able to bring in an expert voice like John Rubino. Before we part, guys, is there anything that you would like to add here based upon conversations you're currently having with people that are calling in and what's on their minds or what you're seeing happening in the markets right now? John Loder, I'll hand it to you to close up with whatever's on your mind.
Yeah, I mean, candidly, I think it feels like a lot of deja vu, frankly, Adam. I think people are beside themselves, scratching their heads at the ridiculousness of what even laypersons can see in the disjoint with reality and what markets are doing. The result of that is a very tiring of one's psyche. We work very hard to keep that from happening to us by grounding ourselves in data and perspective. But for folks that don't do that for a full-time job, we're finding it very tiring and grating on them. And they want to talk to someone who can help them, kind of work through that. And that's what we've been doing a lot of. But other than that, it seems like another week in the tapestry of really ridiculous things, frankly. All
right. And Mike?
Not really much more to add other than that. It is crazy time for sure. But, it's our job to be disciplined and frankly, that's what we're focused on. Waiting for the opportunity.
All right. Well, we'll continue to meet every week here, guys. So I appreciate you joining me for one more here. I thought we might get a little bit lucky in terms of the market beginning to break in a way that would make things a little bit more interesting than just being sort of stuck in this Groundhog Day or deja vu that you mentioned there, John. But I'll see you guys next week, and we'll see what the markets are cooking up. I personally do take a little bit of interest in this island reversal, which the market hasn't been able to close. And tomorrow is OPEX week for the market, and usually the market sort of tries to keep itself pinned up until options expiration, and then if it's going to move, it's usually going to move soon afterwards. So we might find some interesting activity next week. All right, for everybody watching who is wrestling with the uncertainty that's out there, and there's a lot of uncertainty as we've just spent the past 40 minutes talking about, if you want to talk to a financial advisor, we highly recommend you do so. We're not, we're really agnostic at the end of the day whom you work with, as long as they understand the risks that we've been talking about, both here on these videos and at our website, peakprosperity.com. As I always say, if you've got a good advisor who's knowledgeable on that and is working well for you and feels trustworthy, excellent. Hold on to them, keep working with them. People like that are hard to find. But if you haven't found one yet or are having trouble finding one because they are hard to find, if you want to talk to the guys at New Harbor, if you want to talk to John, Mike, and the folks on their team, during this video, as we normally do, I will make sure that the URL to be able to request a consultation with them is shown whenever they're talking. And a quick reminder, those consultations are completely free. There is no obligation to work with them. It's really a public service that the team at New Harbor has agreed to in agreement with Peak Prosperity, because we send so many interested viewers like you to them. So they're happy to talk to you. They're happy to walk through a portfolio review with you, give you their thoughts on what they think you should be considering, and that's all for free. And if you decide you want to work with them after that, above that, that's great, that's on you. But if you don't, it's no worries at all. And with that, guys, another week comes to a close. Look forward to seeing you in a week. And like I said, hopefully the markets give us something a little bit more exciting to react to. But take care, guys. Have a great week.
Take care, Adam.
Thanks, Adam. See you later. Thank you.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you'll work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.